Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 29th of September 2021. Alright everyone, let's get into it. So Vitalk's back with another, kind of proposal, this time around account abstraction. So he worked on this with a few other people, and the reason why this proposal is so interesting is because it doesn't require an Ethereum consensus layer change. So it doesn't require like a hard fork, it doesn't need to be an EIP, it's actually an ERC. So ERC 4337, which is basically, an ERC is a standard on Ethereum. Obviously, a lot of you will be familiar with what ERC20s are. It's like the standard for a token on Ethereum, and there's ERCs for NFTs and stuff like that. And these standards do not require any changes to the base layer protocol. So people use these as a way to do a number of different things without kind of like needing to get anything into the base layer through a hard fork and through an EIP. Now, for those of you who don't know what account abstraction is, it's basically been something that's been around in the Ethereum community for quite a while now. It's been the dream to get this kind of like implemented within Ethereum. And I should take a step back and explain to you why it's kind of desirable. Well, Ethereum currently has two account types. It has what's called an externally owned account, or EOA. You may have seen that talked about before, and a smart contract account. Now, the way it currently works is that when you want to deploy a smart contract, you have to deploy it from an EOA. So you'll have an externally owned account that is just like a normal Ethereum wallet that you and I have, and we'll deploy a smart contract. Now, if you want to interact with that smart contract, whether you're a kind of like, a user or the developer itself, you have to basically interact with it through your user account, through your externally owned account. You can't interact with it directly with the smart contract account. So that leads to a number of, inefficiencies, higher gas costs due to an extra step to interact with it. And stuff like that, and also doesn't allow us to do fancy things like in protocol account abstraction and stuff like that. Now, if you want to learn more about the technical details here, definitely go read Vitalk's blog post that he has here explaining how this is supposed to work. But he did put down the bottom here a bunch of kind of like use cases, and I think the most practical use case for something like this that users will get a lot of use out of is something called sponsored transactions, which allows application developers to pay fees on behalf of their users, which is a really big deal, and also allows users to pay fees in ERC20 tokens, with a contract serving as an intermediary to collect the ERC20s and pay in ETH, which means you would be able to pay your transactions in something like a stablecoin instead of having to pay it in ETH. Yes, of course, ETH is still going to be the token paid at the base layer, but by doing this, it allows the user to pay in whatever they have in their wallet. So if I'm understanding this correctly, it would mean that there's no more requiring users to have ETH in their wallets to pay for transaction fees. It would all be handled by the application developer or kind of like whatever smart contract you're interacting with, which is obviously a huge user experience boon, right? I mean, how many times have people kind of like, this has happened to me a few times before, but I'm sure it's happened to a lot of you before, where you've had an account, you wanted to do something, but you ran out of ETH for gas, or you didn't have any ETH for gas, and you have to go get it from a centralized exchange or send it from another wallet. And then if you don't want to tie your wallets together, you have to go through a centralized exchange, just like a Washer, or you have to go through Tornado Cash or something like that to get that ETH into your new account there to do anything. With these kind of things, with this ERC being widely adopted, basically, if you only had USDC in your account, you would be able to use that USDC to pay for the gas fee, and it would all be handled by the application here, which is obviously really, really cool and a huge user experience boon. But there's a bunch of other things that fall into this as well. I've talked about another proposal that was put forward to kind of like, merge these things together, like the externally owned account and the smart contract accounts together. I can't remember exactly what the EIP was, but I think it's EIP 3 something. And obviously, being an EIP, it would require an Ethereum hard fork to get it into the protocol, and it requires a base layer protocol change. And what that would allow people to do is do transactions where you could basically bundle the approved token transaction and the swap transaction into one. So, for example, when you go to Uniswap and you have to approve a new token for trading, instead of having to do that with something like this, you could basically have like a bundle of these transactions where essentially the user only has to do one transaction to approve the token and the swap, and they could pay in any kind of like currency they wanted for that as well, which I think is really, really cool. Obviously, it's all about improving the user experience, and this is definitely something that people should be paying attention to. It just came out a couple of hours ago, so definitely go give this a read. I'm sure people are going to keep digesting this, and probably someone will do a nice little explainer thread on Twitter for it. I'll definitely retweet that if I see anything, but I think Vitalk does a great job of explaining it in this blog post anyway, so definitely go check that one out. All right, so Mihailo from Polygon highlighted an interesting stat. I think that happened, I guess, over the past few days, is that the Polygon POS chain's daily active users, or daily active addresses, I should say, has eclipsed Ethereum L1 in daily active addresses for the first time. Now, as you all know, the Polygon POS chain isn't a layer 2; it is a side chain to Ethereum, but it's still somewhere where I guess like people are kind of bridged out from Ethereum to go to experience cheaper DeFi and things like that, and cheaper NFT stuff. The reason why I wanted to highlight this stat was not so much, I guess, like to show kind of like Polygon flipping Ethereum L1 here, but more so to show that I think going forward, as we get more of these scalability solutions online, more of these layer 2s online, the daily active addresses for L1 should trend down or should kind of go sideways. I don't foresee it going up because Layer 1 has already priced out a lot of users. So where are the new users coming from? Like none of the new people that are coming into crypto are going to, well, most of them, maybe some of them will, but most of them aren't going to use Ethereum Layer 1 because they've been priced out of it completely. Like you can't expect a new user who's coming with $100 who just wants to try out DeFi to spend half of that on transaction fees. It's just not going to work. So that means that Ethereum L1 active addresses is either going to stagnate or go down over time, which is totally fine. That's exactly what you can see in this chart. I mean, this chart doesn't go far. It doesn't go back that far. It's about 9 days worth of data here. But I've been looking at this, and I'll cover this on the data pump that I will be doing this weekend. But basically, I think we have to kind of like just look at these scalability solutions as the place where these daily active kind of like users and addresses are going to be. These L2s are going to have millions and millions, tens of millions, hundreds of millions of eventually daily active users, and Ethereum L1, because it's inherently limited and it's not going to scale for users, it's going to scale for our layer 2s. You're going to end up in this situation where looking at layer 1 metrics for Ethereum it just isn't going to tell you much anymore. I think the best metrics for monitoring on layer 1 going forward are going to be things like transaction volume settled, so the amount of kind of like amounts settled on the network, so like trillions of dollars of settlements happening there. You also have to kind of like have a way to unpack the amount of dollars being settled on L2s and then kind of like unpack that in the batches that are posted to L1. I'm sure there'll be tools to kind of extract this, but other things also include kind of like the fee revenue, of course, that's paid on layer 1. That's obviously a huge deal, not just for the fee burn, but just to kind of like see the usage of L1. And we can't measure L1 by kind of like active addresses and stuff like that to see the health of the Ethereum L1 network. It would definitely be stuff in the L2 world, but still cool to see, I guess, like this happening from Polygon. You know, I mean, I guess like I've given the disclosure plenty of times that I'm an advisor to Polygon here. I'm not trying to shill it too hard, but I think what's interesting about the POS chain is the kind of like incentive program that they had. And I'm going to talk about this tweet from Polynya. I think it's here. Actually, I'll talk about this in a sec. But basically, when it comes to incentives and like incentivizing the usage of layer 2s and scalability solutions and kind of like anything really at the end of the day, any base layers or like apps or whatever, the mark of a good liquidity mining program is if it actually leads to sustainable growth in the long term. And that's exactly what happened with the Polygon chain. They had that massive liquidity mining program where they paid out Matic rewards and they got people onboarded onto the POS chain. And it's been sticky. They've been able to grow their kind of like daily active addresses. They've been able to grow their TVL in different apps, which again, TVL is becoming a bit of a crappy metric, or has become a crappy metric, which I'm going to go over as well probably at the end of the refuel. But those kind of metrics are what we need to look at. And on the liquidity mining front, I did want to point out something that Polynya tweeted out where they said, tokens are critical for rollup projects. Interesting data point from dYdX. Daily volumes when the token was announced shot up from 25 million to 300 million. And you'll remember when I was covering dYdX, and I think I said on the refuel, like, just wait until they add a token. And I didn't even expect it to grow this quickly, but it has. But they released their token and they quickly went from $300 million of daily volumes to $9 billion, which is more than every centralized exchange right now, I believe. Absolutely massive. Obviously, the dYdX token has gone up a bit in price lately over the past week. I think it's like doubled, or past couple of weeks or something like that. People are earning token rewards and all that good stuff. But I think what I wanted to point out here was something I wrote about in the newsletter today, and that's the sustainability of liquidity mining programs. I mean, we all saw plenty of these. Well, I mean, we've all seen plenty of these things play out over the last, I guess you could say, 18 months. I would say that, I mean, I would argue that Synthetics pioneered liquidity mining in early 2019, where they did their staking, where they paid SNX rewards out to SNX stakers, and then Compound popularized the model, but when they launched their token in June of 2020, which kickstarted DeFi summer, which led to, you know, the countless amounts of liquidity mining programs in that kind of like window of time. But then all through 2021, we've seen different ones, whether it be for base layers that are trying to get traction, for layer 2s, for different apps. It's all been happening. And we've been able to run these experiments over and over again. And I think the prevailing theme here is that a lot of applications are overpaying for, a customer acquisition strategy, which is exactly what these things are. They're trying to bootstrap growth by paying people to use the products. Now, these things fail for a few reasons. One, the product doesn't have product market fit. It really only had attention because of the liquidity mining. Two, there's liquidity mining locusts who come along. They basically mine all the tokens, they dump the token price, and then the community is left to pick up the scraps. But essentially, you're left with a community that may be underwater on their investments, which obviously doesn't end too well for a lot of communities. Or three, they have a liquidity mining program and it's just not working. It's not doing what it should be doing. It's not attracting new capital. The app's kind of stagnated. Now, that could also be for other reasons, like maybe the app can't scale and they've been on Ethereum layer 1 and it's very hard for them to gain any more traction because they need to move to layer 2. There's a lot that goes into it. And maybe they have just really bad marketing or business development. It's not black and white. It's kind of like multifaceted here. So I think there's been a few really good examples of liquidity mining that has led to sustainable growth. Obviously, I was talking about the Polygon POS chain. I think the Index Corp did a really good job here as well. They had a very conservative liquidity mining program. And still do. They didn't have like a pool 2 or a native token incentivized pool, where essentially the native token of the project has a pool on, say, Uniswap or SushiSwap or whatever, and then the protocol is paying out token rewards to be in that pool. That was known during DeFi summer, and even to today, was known as like exit liquidity pool, where the pool 1s, where the people kind of like farming the token rewards outside of the pool 2, were dumping their token rewards into the pool 2. So it wasn't a good model. It led to a lot of death spirals in token prices and all that sort of stuff. So, yeah, I think that people have learned from this. Projects have learned from this. I think, dYdX's liquidity mining program seems to be quite good. It definitely is paying a lot of money out right now, though. I think they paid 27,000 tokens for the last 2 weeks worth of liquidity mining. And that was, 27,000 times the current price of $25. It's a lot of money, right? It's a lot of money to be paying for liquidity mining. Tens of millions of dollars there. But I guess that's because the token price is high. 27,000 tokens out of their total supply of I think the total supply is like, I can't remember what it is, maybe 100 million tokens or something like that. And they're kind of getting it out there. It remains to be seen what's going to happen to dYdX's token price. It has a really high market cap, fully diluted market cap already of $25 billion, but it also has a lot of traction, right? Like it's doing a ton of volume. It has lots of new users, a lot of attention on it, but I can't say what's going to happen with the price at all. Like I have no idea what's going to happen. There's still only 5% of around 5% of the token supply circulating. So we'll see what happens in the long run. I've seen this game before. It usually ends in kind of like the token bleeding out over time, but we'll have to see how it plays out there. I'm not going to tell you if it will or will not bleed out over time, but it's going to be interesting to see what happens over the next few months there. And speaking of Polynya, moving on to the layer 2 stuff now, they put out another great tweet today where they said, this is an opportune moment to repost this fantastic graphic by emkoscp from Reddit. This is the multi-chain future, just not the way everyone thinks. It's modular, not monolithic, with Ethereum at the heart of it until we see a better security chain. And you know what I love? I love this about Polynya. They aren't an ETH maxi, but they recognize that Ethereum is the best security chain right now for layer 2s. And to be honest, as I've explained plenty of times on the Refuel at this point, I don't think any chain is going to be able to catch Ethereum in terms of security and decentralization, because Ethereum is not a static thing. Ethereum is not Bitcoin. Ethereum is moving forward. Ethereum is always trying to improve itself, whereas Bitcoin is static. So it's very easy to catch Bitcoin when it comes to security and decentralization, but it's very, at least for Ethereum, I think it was relatively easy, whereas to catch Ethereum is relatively very difficult. But anyway, this chart here is great. I mean, you can see exactly what I've been speaking about lately. You have Ethereum in the yellow here, which has basically the execution layers, kind of like, and the consensus layer and the data shards. Now, the execution layer is being fed into from rollups. The data shards are obviously, when we have sharding, you'll be able to put rollup transaction proofs and all that sort of stuff on the data shards, and the consensus layer is the beacon chain. I mean, I'm talking about like a post-merge world. In the current world, it's kind of like the proof of work kind of consensus, but in the future, it's going to be the beacon chain, which is the consensus layer. And then you not only have rollups, but you have like validiums and volitions and side chains and alt layer ones, which all act as the execution layer, as I've spoken about before, which is basically the compute layer, as I spoke about that yesterday, about the commoditization of compute, where the real kind of like moat becomes the decentralization and security of the chain that the compute layers are kind of like pulling into, or kind of like bridging into and out of, and securing themselves on. So I just thought this was a great little chart to kind of point out. Definitely, if you're listening to the podcast, I mean, this will be linked in the YouTube description. You can go check it out. But I'll be talking more about this on the AMA on Saturday. Actually, there's a few questions around this, and people want me to explain like the difference between validiums and volitions and how this all works. So I'll definitely be talking about it on the AMA. Join the Discord channel for full details on the AMA there. But moving on, speaking of, I guess, like dYdX, Eli Ben Sasson, from Starkware tweeted out this interesting chart here where he said that dYdX has been doing 10 TPS, 10 transactions per second, with peaks above 25 transactions per second over the past 12 hours. This is higher than Bitcoin and Ethereum for a fraction of the gas cost. And you know what's always funny about these sorts of things is, you know, someone asked how high can this go, and theoretically it can go to 10,000 transactions per second or more, but look at how much traction dYdX is having and how much volumes they're having, and they're not even getting to above kind of like 25 transactions per they're not even getting to like 30 transactions per second here. So this is why I always find it funny where people don't realize just how much space, you know, we're kind of like bringing online on the compute layer, and how good rollups are going to be even at 1,000 transactions per second, like even the generalized ones. Yes, that space is going to get filled up eventually, but in the short to medium term, we still have time to grow these things out. We still have time to deploy these things right and build them right, and then scale it up to hundreds of thousands, if millions, tens of millions, maybe one day billions of transactions per second. Like it's kind of hard to fathom how much throughput that is for these kind of things here, and how much activity there's going to be. Like these layer 2 exchanges, they're going to be doing trillions of dollars of volume one day. Like and that day is coming quite soon. I mean, dYdX, as I said, is doing $9 billion of 24-hour volume. And it's so small still. Like the unique traders on there is very small. I would say that 95+% of traders haven't actually traded on dYdX yet. So from that perspective, just absolutely incredible kind of like growth there with these kind of like TPS numbers. Now, it's funny because when you think about TPS and think about kind of like, I guess, the limits of it, Ethereum can do, I think if every transaction on Ethereum was just a simple ETH transfer, which is the cheapest transaction you can do, Ethereum could theoretically do 45 TPS, 45 transactions per second. But in reality, the Ethereum chain is being used for much more than just simple ETH sends. So we average about 15 transactions per second, maybe a little bit less than that. And that's like the maximum unless we raise the gas limit. Obviously, if we raise the gas limit, we hit that ceiling really quickly again, and the fees just go up anyway. Whereas, and that means that like the amount of transactions per day that can go into, I guess, like the chain, the amount of activity that can happen is constrained, and logically it flows that only the most high value use cases will be using Ethereum layer 1 because they're the only things that can afford the high gas fees. But then you turn to the layer 2 world where you have tens of thousands, hundreds of thousands of transactions per second, getting to that, and reaching that kind of like capacity in a kind of like constant demand, ongoing way is going to happen one day, but it's still a little bit of far out. I think that's going to happen in a world where we're kind of, I guess, like probably at the edge of like the early adopter phase, where we're moving on to kind of like the mainstream phase, where one of these layer 2s have just kind of like, experienced an incredible amount of growth, experienced an incredible amount of network effect, and is really kind of like just overtaken the whole scene, whether it be your Arbitrum, Optimism, ZK stuff, like Starkware, ZK Sync, Hermes, whatever it is, right? At the end of the day, then you're going to see kind of like that stuff fill up. But I think the funny thing is by that point, we're going to have just so much capacity through these kind of like layer twos and stuff like that, that we're not even going to talk about this stuff anymore. We're just going to talk about the fact that people can use these things really, really cheaply, because the transaction fees on dYdX are free right now, and I think they're going to be free in the future. And I'm talking about gas fees, because dYdX can sustain itself and still post proofs to layer 1, still secure itself on layer 1 Ethereum by just using the trading fees of their exchange, which is a really, really good business model. It basically means that dYdX is making revenue. Their costs are their costs to secure themselves on Ethereum, and obviously a bunch of other costs like personnel and marketing and whatever else they're using their kind of like funds for. But that just factors into another cost for them. That's the same thing that's going to happen for every layer 2 at the end of the day. They're not going to have an issue paying for layer 1 security if they get traction. Like obviously the layer 2s that don't get traction are going to have an issue, but I'm expecting all the top ones to not have an issue with this sort of thing here. So yeah, really, really cool stat from Eli here, and just had my brain kind of like spinning earlier today. Speaking of layer 2s as well, Optimism have announced dates for OVM 2.0. This is the major upgrade that they have coming out for the optimistic virtual machine here. And I've spoken about how I think that once this update is rolled out, they're going to remove their whitelist and the floodgates are going to open for Optimism. But essentially, 2.0 is going live on the Kovan testnet on October 14th. Mainnet will be October 28th. And there'll be 4 to 6 hours of downtime on those days. And then, if you want to join their Discord channel, you can keep up to date there with announcements and all that sort of stuff. But yeah, this is exciting. I think that this update's coming with reduced gas costs, which is really cool. It's also the update that allows for EVM equivalence, not just EVM compatibility, which is a really big deal. And I'm excited to see how many projects deploy to Optimism once their whitelist is removed, which, as I said, I assume is going to happen after this goes live. So yeah, I guess like another about a month out until this goes live. Not too long, to be honest. I mean, I'm probably going to still be in lockdown at that point. So time just kind of like blurs together for me these days. So I am kind of like a very patient person. But yeah, still exciting to see there's some dates around this. Bridges, more news out of bridges here. So Connext NXTP is officially live on Mainnet with support for Arbitrum, Polygon's POS chain, the XDAI chain, Phantom, and BSC. So what is NXTP? It's basically a base protocol for transferring assets and calling contracts between Ethereum domains, chains plus L2. It's unique in 3 ways, and that it's trustless, extensible, and capital efficient. And you can use it at xpollinate.io to kind of like bridge between these chains. And if you want to learn more about it, you can definitely check out this thread from Connext here. So just another bridge live, right? Like, I mean, I feel like I've been talking about bridges nonstop on the Refuel for like months now. And it's just because it's just fascinating how fast these things came to market, given that the L2s are just now rolling out and the bridges were just waiting. They're just like, yeah, we're ready. We can deploy these things. Come use us. Don't have to worry about withdrawal delays or anything like that. Don't have to worry about capital inefficiency. We've got the solutions here. So super excited about that. And I mean, a disclosure, I'm an investor in Connext here. But this follows kind of like my logic and thesis around the L2 and bridge space, where, again, I'm going to answer this question in more detail on the AMA on Saturday, but it's kind of like where I'm placing all my bets, right? L2s, bridges, all the supporting infrastructure around that. The next 5 years, I believe, and this is an investment advice, but I believe those are the best investments in both kind of like in both a financial way and your social capital way in this space. Because I went over the other day on the Refuel where I said, 2016 and 2021 was the layer 1 era where all these layer 1s were battling it out and they were kind of like messy and a lot of them were shitty and scams and just like stupid projects. And then we're going to have the L2 era, which includes things like bridges over the next 5+ years. And I think that people betting on these ecosystems, getting involved, both with their money and their kind of like time, it's going to pay off in a very big way. I have so much confidence in the layer 2 ecosystem. and the kind of like bridge ecosystem here, and just like things around that, like Rari Capital's Nova and Starkware's DAMM and any other stuff there, that I'm literally putting as much kind of like time and effort and money as I can into these things. I'm betting on them with everything at the end of the day. Obviously, like buying ETH is a bet on it as well, because it's all gonna, a lot of that value is gonna flow to ETH through the fee burn and other kind of mechanisms. But just like making more targeted bets as well is something that I've been doing lately. So as I've said, like I expect pretty much everything to have a token. So if you want to get exposure to this sort of stuff, because I don't know if any of these sorts of things are going to do public sales, like I doubt they will, just use the apps, use Connext, use Hot Protocol, use Arbitrum, use Optimism, just use everything. Use Starkware, and you can do that in multiple ways, like you use Immutable X and Diversify and dYdX, obviously. Just use it all. Do it all. Like even if it costs you like $50 or $100 worth of fees to bridging and to just do all these sorts of stuff, I'm telling you now, it's most likely going to be worth it once all these tokens start coming out, these airdrops start coming. As I mentioned before, I expect these protocols to be worth billions, tens of billions of dollars, because they are definitely the future and where everyone is kind of like going towards. Anyway, I'm going to leave it at that. I'm going to go over in more detail about this sort of stuff on the AMA on Saturday, so definitely kind of like check that out. And another thing on bridges, Etherscan has added a feature where you can basically click here, it'll show you on the contract that this is the Arbitrum bridge. You can click the little link here and it'll take you directly to the Arbitrum bridge. So a little bit of a quality of life improvement there. They also have a bunch, kind of, I guess, like a list of different bridges on blockscan.com here, where you can basically go through it and see where the bridges are, what contract address they're at, and all that good stuff there. So really, really cool feature from Etherscan. Another project that I came across yesterday for the first time, it's another layer 2 project, another zero knowledge project called, and their team is called Scroll Tech, and they're working on a zk-EVM, so similar to what the Polygon Hermes project is working on. And this is really exciting. I mean, you can have a read here of what they're doing, but I'm super excited that I found just another layer 2 project that's working on a layer 2 specifically for Ethereum and specifically around a zk-EVM, and obviously using zero knowledge proofs and all that sort of stuff. So definitely go check this out if you haven't already. I think I'm coming up on time here, so I'm going to power through the rest of the updates today. Danny Ryan posted another finalized blog post, number 29, with details on Altair, which I went over yesterday, and the merge that is coming. So the merge, as I said, is like the thing that's kind of like, I guess, going to be the theme over the coming months, but an initial merge interop specs are out right now, and the engineers are busy preparing code bases for the coming devnets in October, as I've discussed before. This is the first step. We have the devnets, then we have the testnets, then we have mainnet. So expect, obviously, this to take a little while, but if everything goes well on the devnets and on the testnets, mainnet will come sooner. But I say that, not everything always goes well. There's a lot of kind of like stuff going on here. The merge is a big effort. Definitely not something that's going to happen overnight. But great to see an update from Danny Ryan here. So definitely go check this out. It's got relevant links to everything. And speaking of, I guess, like ETH2, ChainSafe has published NodeWatchIO, which is a website to keep track of Ethereum consensus nodes, aka ETH2 nodes. So you can see here the node count. This is the beacon node count. This is not validators. So one beacon node can have like potentially an unlimited amount of validators talking to it, depending on the hardware that's backing it to be able to service those validators. But these are basically the equivalent to a full node on ETH1, because there's the beacon node and there's a validator client. So there's currently 3,794 beacon nodes that are basically able to be scanned by this tool, publicly accessible. There could be more. These tools are just measurements, are just kind of like best guess measurements. They are definitely not 100% accurate, because it's very hard to get 100% accurate kind of view of the network. But you can see here, this also gives regional information. There's 60 countries participating in ETH2 right now, which is really, really cool. Only 40% of those nodes are hosted nodes, and 60% of them are non-hosted nodes. So if a node is running on a network other than a cloud service, then it's considered non-hosted. So basically home stakers, which is really cool. You can see the node count by countries here. Obviously, the USA is leading at 25%. Germany coming in second at 20%. France at 15%. And then you have a bunch of the minorities here. Australia is only 2.2%, with only only 87 beacon nodes there, so I'm I've got my little share there. But I mean, I think it's actually pretty distributed considering kind of like the population. You have to do obviously a population based distribution here. Scroll down, you have node statistics, as I was talking about, like Prism leading the charge here on the node count, and then Lighthouse coming in second, and then the rest of them kind of like being minority clients here. That should obviously change over time, right? And that should definitely and there's obviously a big push to get Prism to be less of the network as well. So really cool tool here. Definitely go check it out, or I'll link it in the YouTube description. Dopex, a kind of like decentralized, I think, options protocol. Yeah, options protocol here has announced that they're migrating to Arbitrum. So they're going to be migrating on Monday, 4th of October. And how to get involved and take advantage of this is all in their Discord channel. So definitely go join that. This will be linked in the YouTube description. Matcha has announced that they've launched gasless trading in open beta today. So Matcha is a decentralized exchange aggregator on Ethereum, supporting a bunch of different chains out there as well. But essentially the reason that they're able to do this is because they've got market makers that complete these orders. And the thing is, you'll get a slightly worse price than you would if you paid the gas fees. And basically the logic is that yes, you're getting a slightly worse price because the market maker is essentially paying the gas fees for you, but it's just, I guess, like a user experience boon here, which I think is pretty good at the end of the day. I think a lot of when I think about like the just like mainstream user and what they actually care about, I think about MetaMask and their swap feature where they actually charge 0.8% fees on top of the 0.3% that a lot of the decentralized exchanges already charge. So end user is paying 1.1% in fees, and they're happy to do that. And they're paying the gas fees, right, through MetaMask swap because it's just convenient. They don't have to worry about anything else. They just do it through that and they're all good to go. And the same goes for centralized exchanges. People pay 1%, 2% fees without even blinking an eye. And why would you? When you're buying an asset, you're expecting it to go up in value much more than 1 or 2%. That's just like a cost of doing business to you. Now, obviously, if you're a trader, like an actively trading, those fees are going to eat into your profitability. So you worry more about that. But Matcha doesn't really target traders. I mean, Matcha is targeting the retail investor, the ones who are just like buying something, wanting to sit on it for a while. So I don't think they're going to care too much about getting a slightly worse price for saving on gas costs. It's just like kind of like flipping the cost I guess like paradigm here over to kind of like a slightly worse price in return for paying no gas fees. So yeah, still cool to see that coming out of Matcha there. Another thing that maybe I'm going to go over time here because this is something important that I wanted to talk about. I was mentioning before how I don't think TVL, total value locked, is a good metric at all anymore for a number of different reasons. I've written about this in the Daily Gwei newsletter before, but the major reasons are TVL is fleeting, right? And it's fleeting because of liquidity mining. Like you can get $1 billion, $2 billion, $3 billion of liquidity really, really quickly if you pay a lot of token incentives for it. But if those token incentives run out, which they eventually do, or they don't become as lucrative because the token price dumps, then the TVL is going to leave as well. So we should be looking at both sustainable TVL, but also other metrics. And the MakerDAO growth kind of like Twitter account here tweeted out a little meme. And for Maker, you would look at outstanding loans, the organic revenue that's being generated, the amount of DAI that's issued, the PSM fees, the Peg Stability Module fees, burned MKR tokens, and general market share, as well as a bunch of other kind of like things around that, like general awareness, analytics of the sites that tap into Maker, and kind of like the users there, the amount of unique addresses holding DAI, all that sort of stuff, right? That is much better at measuring a growth of a protocol and measuring the kind of like metrics around a protocol than TVL is. I think TVL is a vanity metric. I think the more projects use it, the less I think of a project if they use it to show kind of like anything, I guess, like any kind of signal around their project. Definitely focus on the stuff that makes your project unique and the stuff that actually generates organic growth and organic revenue for the protocol. I think that's really, really important. All right, last thing here, talking about stablecoins. Angle Protocol has announced that they've raised a $5 million round led by A16Z with participation from a bunch of other kind of like investors here. And they're building a derivatives-backed stablecoin for a more inclusive DeFi, as they put it here. So if you want to read more about this, definitely check out the blog post. But again, another kind of like stablecoin project that's kind of been announced here and obviously being built here. I mean, I think it's funny because like, solving or becoming the biggest stablecoin in crypto and DeFi, and biggest decentralized one especially, is the holy grail. Like, your TAM is everyone. Everyone uses stablecoins, right? Like, absolutely everyone's going to use them in the world. So if you can kind of like get traction there and grow yourself, and even carve out like a small piece of that pie, which is the quadrillion-dollar pie eventually, like maybe hundreds of trillions of dollars worth of kind of like trading volumes, and then quadrillion dollars worth of trading volumes as well. If you can just, I guess, like carve out a small kind of like piece of that pie, it's very lucrative. So that's why you're seeing so many stablecoin projects pop up. But anyway, go check this out. It'll be linked in the YouTube description, but I'm going to end today's episode there. So thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give that video a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks everyone.